Hey, how's it going? Bill Letherman here for Money Evolution. In today's video, we're going to be talking about when you can access the money inside your Roth IRA account without tax and without a penalty. Now, this is something that keeps coming up over and over again, and I think it's a very confusing topic. I've made some other videos here recently where I sort of get into some of the details of this, but in today's video, I'm going to really explain what monies are available, when they're available, and when you could get those monies out tax and penalty free, and when you could potentially get hit with a penalty and or a tax on your withdrawals coming out of your Roth IRA. So this is something that came up recently with a couple of clients, and as we were answering their questions, there's always a couple little twists to it. So I went back and I did some additional research and continue to do some research here for today's video. In fact, I've got index cards and everything laying all over my desk here, and we're going to get into all of those details here today in this video. And by the way, if you haven't already, be sure to check out our blog at moneyevolution.com. We put together a lot of resources and a lot of guides on different topics over there, and a lot of the videos that we do here end up over there, not just as a video, but also with written text copy. So if you'd rather read rather than watch videos, or at least have something that you can reference while you're watching the video, head over there. And if you'd like to learn more about what we do at Money Evolution, we've got two great financial planning, retirement planning programs available, and you can check both of those out as well. Okay, so let's jump in. So the first thing we want to understand is, how is the IRS going to treat any withdrawals coming out of your Roth IRA? And there's really three categories of money that is inside your Roth IRA potentially. And what we have here is the IRS ordering rules. So the first thing that's going to come out of your Roth IRA is going to be any contributions that you've made. And remember, your contributions are available to you at any point that you want, any age that you want, regardless of how long you've had that money invested there. So you could literally put $5,000 into a Roth IRA account this year and take it out next year without any tax or penalty. And that's the contribution portion of that. So contributions are going to come out first. The second thing is going to be any conversions that you've made. And we're going to get into the details here on the 5-year rule for both conversions and contributions and earnings. But what we need to know here for the conversions is that those conversions are never going to be taxed as you withdraw them at any age that you want. You've already paid taxes on that. So if you did a Roth conversion, the idea of that is you took money from a traditional IRA account, you paid taxes on it, and you converted it over to the Roth. So there's never going to be any additional tax on that at any age. There could potentially be a 10% penalty on that conversion money if you take it out before you're 59 and a half. And we're going to get into the details of when that is going to apply. And number three is going to be the earnings that you're going to have on the Roth IRA account, whatever the money makes and whatever investments you happen to have that money invested in. And in order for earnings to come out tax and penalty free, you have to meet that 5-year rule. We're going to talk about what that looks like for contributions and conversions, but you also have to be over the age of 59 and a half for it to be a qualified distribution. Okay, so now let's get into that 5-year rule. And this is going to be a very important concept to understand, because when we get to the next page and we look at the chart, it's going to tell us whether or not we're going to have a tax or a penalty, or potentially a tax and a penalty on certain aspects of that money that's in your Roth IRA account. So two categories of the 5-year rule. The first one is contributions. And the way the 5-year rule works on that, in order to it to be qualified distribution, is that clock is going to start ticking from that very first contribution that you make to your Roth IRA account. And that contribution is going to start the clock ticking effectively on January 1st of whatever tax year you make that contribution to your Roth IRA account. So you could literally make a Roth IRA contribution on April 15th on tax day for the prior year. Let's say that's in 2025, and it could actually count for the clock starting to tick on January 1st of 2024. And in order to basically have those contributions allowed for that tax and penalty free, again, two criteria need to be met. Number one, you have to be over the age of 59 and a half. And two, you had to have had that Roth IRA account open for at least 5 years. Doesn't matter how much money you put into that. You could have put $5 into it, and as long as that's been incubated, if you will, for 5 years, you could have put hundreds of thousands of dollars in later, and that's going to start that clock ticking. So you're now in that qualified distribution. Roth conversions are a little bit trickier. Remember, Roth conversions have to be made during the calendar year, so we don't get till April 15th to do a Roth conversion. So if you do a Roth conversion, for example, anytime in 2025, it could be on January 1st or December 31st, you're going to actually get credit as if you did it on January 1st. So that 5-year clock is going to start if you were doing that in 2025, any point during the year on January 1st of 2025. And then you roll forward 5 years after that, and that's going to become now qualified for distributions. Okay, so let's jump in and let's see what this looks like here as we start to apply some of these rules that we've just been talking about. So up here, I have a chart. I know it looks a lot busy here right now. I'm going to, by the way, try to create this in maybe a graphical format. We'll probably put up on our website at some point. Make it available to have people reference this. And over here on the left, we have basically our 4 types of potential distributions coming out of our Roth IRA account. We have our contributions, we've already talked about that, taxable conversion and non-taxable conversion. And we also have the earnings, any money that it's made from investments while it's inside of the Roth IRA account. Now, some of you may be asking, well, what's the difference between a taxable conversion and a non-taxable conversion? Well, if you've ever heard me talk or anybody else talk about backdoor Roth IRA contributions, that's what we're talking about with non-taxable. So that would be that if you didn't have any other existing traditional IRA accounts and you wanted to get money into a Roth, one way of doing that is to make a non-deductible contribution to that traditional IRA account and then immediately or somewhat immediately convert that over to a Roth. Again, there was no tax due because that money was contributed with after-tax dollars. If you do a taxable conversion, that's going to be, I have $100,000 in my traditional IRA account. I want to do a $10,000 conversion this year. So we're going to convert that from traditional to Roth, and we're going to pay taxes on that $10,000. So the order of this is going to be contributions, then the taxable conversion, then non-taxable, and then finally the earnings. So we can see here, I've checked this off in green, where we're allowed to take that out without any tax or penalty. So again, our contributions are always available to us, no tax or penalty. That taxable conversion, and again, it's going to depend on if you're before 59 and a half or after 59 and a half. So if we're talking before 59 and a half and you haven't had that conversion for 5 years, and every conversion, if I didn't say it before, make sure we understand that every conversion starts a new 5-year clock. So if you did a Roth conversion last year, it's going to be 5 years from 2024. If you're doing a Roth conversion in 2025, it may be 5 years from this year here. So every conversion is treated independently of that. So you want to make sure that you're following that rule. But if you're before 59 and a half and you haven't had the account open for 5 years, you're going to have a 10% penalty. Remember, because you already paid the taxes on the conversion, they're not going to tax you again, but you could get hit with that 10% penalty, and we don't want that. Once you've had the account open for 5 years, you could be 45 years old, and you could take that money out tax and penalty free as long as you've had that Roth conversion at least 5 years ago. The non-taxable portion, that's going to be tax-free for you at any point, but they are going to take that taxable conversion first. So if you have done any taxable conversions, you're going to want to be careful of that if you haven't had that conversion incubate for at least that 5-year period. But if not, you can take out that taxable conversion at that point or after you've already exhausted that taxable portion of the conversions. The earnings, that's going to get a little bit trickier. That's going to be the point where, again, the 2 rules that are going to have to be met is that it has to be after 59 and a half, and you had to have had the IRA account open or the conversion for at least that 5-year period. Even if you're over 59 and a half and you don't meet that 5-year rule, you're still going to have an ordinary tax. They won't penalize you because you're over 59 and a half, but they're going to tax you on that. So again, we'll try to get this graph up on our website at some point in the near future. But anyway, I hope this has been helpful to help you to understand where this comes in. And one of the things that kind of prompted this video is we've, again, worked with a couple clients here recently, and I had a client that has a large purchase coming up, and he wanted to basically see how he could basically take the money out of his IRA account. He did not have a Roth IRA or does not have a Roth IRA account at this time. So one of the things, because of the large dollar amount, we suggested to spread that distribution out effectively over a couple of years because he doesn't actually need the money until 2026. So I said, let's take part of it out this year and have it fall on 2025 tax return, and then we'll take the rest of it out in 2026. And that way it's not going to push him up into a higher tax bracket. Well, then he said, well, you know, what if I don't go through with this? What if I don't end up making this purchase? What can I do then? Can we put the money back? And I said, well, not really, not easily. You know, there's that 60-day rule to get the money back back into the IRA account. But then I started thinking about it, said, well, hey, maybe a Roth conversion would work out well for him. So what we're going to do instead is we're going to do a Roth conversion for half the money, basically this year, and that way it's going to be in a Roth IRA account. And then if he needs the money for his purchase next year, he can take that distribution because again, it's Ben, is over 59 and a half. We can't take the earnings out if it makes any money between now and next year when he does that, but he can take out his contribution or his conversion amount tax and penalty free. So if he does decide to go forward with the purchase, he can take that money out. But if he doesn't, now he's done the Roth conversion and we've accomplished what we kind of wanted to do, which was to fill up the 24% tax bracket and basically take advantage of that. So either way, he's got a couple of different options there with that. So that's one of the things that prompted me to make this video. I hope this made sense. Hope you enjoyed it. And like I said, hit the like and subscribe button, check out our channel. And if you'd like to learn more about what we do at Money Evolution, we have 2 great programs for financial planning. One of those is something we call the Retirement Time Machine. And you can check that out at retirementtimemachine.com. Thanks for watching. I'll see you back in one of our next videos.